Hello, everyone. It's Bill and Wendy with the Bill and Wendy Show.
Oh, you sound really like you're excited today.
I am. Can't you tell?
So he's frustrated.
I've been scrambling all morning trying to get the equipment to work because
poor guy.
It was not cooperating, but it's cooperating now. So yay!
Yeah. Is it working right, or do we just have it rigged to work for the moment? Oh, working left. I like that. I like that.
It's working to its best of its ability.
That's right. So you are at the ugly question session, ask an ugly question session today.
Right. And we are Carolina Capital Management. More information about us, go to carolinahardmoney.com. If you're a borrower interested in borrowing some money, then click on the borrower tab. If you're an investor looking for passive returns, then click on the investor tab. Don't forget to share, like, subscribe, all that stuff. If you have any questions of your own, we also have a chat box there that you can type in a question. We'll do our best to get it answered. And even if it's after the show, you're watching this recorded, put something in the chat. We have people that'll scrape the questions that weren't there during the show.
That's right. That's right.
We'll either answer them in another show or somehow you'll get it answered.
Yeah. I think we can probably figure, if you leave an email when you ask the question, we can certainly email the answer, right? That would be a good follow-up clue on it.
Well, you know what today is, right?
Thursday.
Yay.
September 3rd.
But you know what Thursdays are?
After Wednesdays?
Unemployment numbers.
Oh.
So they expected just under 1 million in new requests for unemployment. Came in at
do you remember?
somewhere in the 800,000.
Would that be lower eights or upper eights?
I don't know, but it was lower than expected. So
well, that's
is a good thing.
Yeah, that's really good. That's very good. I'm really glad to hear that.
And then they were expecting 14 million continued, and it came in, in the lower 13s.
Okay. Well, I hope all that gets blamed on Trump like they blame everything else. The good stuff too, right?
So it looks like the employment picture is getting a little better. I think when, I don't want to get too deep into this.
Well, as they open things up, things are going to change.
Things are opening up more in some of the other states that had more restrictions. And, even if you're at home getting unemployment, eventually people get sick of being at home.
Yeah.
And they want to do something else.
Yeah.
There's plenty of opportunities depending on where you are and what your skill levels are. But there's still plenty of people that are unemployed.
That's right. And it's just a different world. In fact, our show that we're doing at 105 that it actually goes on?
Yes.
Yeah. So the one that we're doing at 105, right after this one, we're going to have some local folks, Jeff Johnson and Don Harris, talking about today's market, what's going on here, not only here in the Carolinas, but what they're seeing across the nation as well.
Yeah.
Both of them are full of it, full of great information that you won't want to miss. So
awfully nice of you.
So be sure to join us for that. We do have two questions.
By the way, I wanted to mention Jonathan usually joins us, but he is a new dad. So
yeah.
He's got some dad stuff to do.
Yeah.
So he won't be joining us. Housing, I'm still very optimistic. I know you are too.
I am very optimistic, but I'm cautiously optimistic about it. I'm still really concerned about the houses that are where the after repaired value are over in our area, say the Carolinas or the Southeast even, where they're over 500,000. I'm still concerned about it. I know that there are going to be pockets where it's really selling good, and you're going to hear from Don Harris talking later on today in the next show, where he's really got his finger on the pulse of what's going on. And I know the high ends are selling for him and what he's seeing there. But
the thing about that is, how long is that going to last?
Yeah.
If you look at it, let's say, for example, you're employed in Silicon Valley, and none of those places you're having to go to work,
Right.
but you're making six figures. You decide you're going to move to a place that's more affordable because anecdotally, I heard a story about a guy that was having to share a bunk bed in, a house in San Francisco. He wasn't sharing the actual bunk bed. He had a bunk, but he was paying $1,400 a month for his portion of the room
Wow.
that had a bunk bed.
Wow. That's awful.
And that's how unaffordable that town is. So if you have that kind of money and you can move to Charlotte or Nashville, and you can afford a $500,000 house.
Yeah.
No problem.
Yeah. And you don't have to share a bunk.
But eventually all those people will have, migrated to other places.
Yeah. Yeah.
So I think that we're going to see sales. I'm not going to say the top luxury homes, but probably 600 and under.
Yeah.
For at least the near future.
Yeah, I agree.
But we still want to stay safe and stay
absolutely.
in the affordable
And
housing,
you should
what.
too. You should too. Be cautious with what you do. I just, in fact, right before I walked in to sit down in this chair, I just got off the phone with a new investor, newer investor. She's done a couple already, she and her husband, and they're from Waxhaw, North Carolina. And she has a property that she wants to build. And in that neighborhood, those houses are going from 750 to 1.3. And she's already been given a bid by a contractor that was done about 3 weeks ago. And which is great and wonderful. Of course, it's not a deal that we would consider because we don't lend on properties where the after repaired value is that high. But my caution to her was, number one, if she got a bid 3 weeks ago, she might want to revisit that bid because just lumber alone in some cases are up 130%.
Wow.
That's huge. That can change everything for your build cost.
Well, especially a house that size.
Oh yeah. It's crazy. And I don't know how long that's going to last. I was talking to a couple of builders yesterday about that and asking them why they think it is. Why is it? Why has it increased so much? What's pushing that? And I think the number one answer that I got from both of them was during the COVID crisis, when we were all really in the major lockdown, that a lot of the mills slowed down and just didn't have the production out there that they had.
So slow down or shut down.
Yeah. And then, stuff comes from China. So I think they were having some problems with that as well. And then
they shut down.
And then one of them mentioned that it could be, the hurricanes, but I don't know that we would feel the pull from that quite yet.
Well, if you're not, you will.
Does it change that quickly like oil prices do? Well, here comes a
commodity as well. People are going to more demand.
Yeah. But that's something to consider because, new construction starts are huge right now. And having lumber be exceptionally high. We were getting quotes of, between $85 and $95 a square foot to build a house. Now they're at 110 to 120. And that's for, again, in the affordable housing market. That's a big difference on whether or not you can really make a profit if you're an investor builder, right?
Well, all that said, when you add some extra zeros to your project, you better have some extra zeros in the bank.
Yeah, that's for sure.
Because if anything goes wrong, any kind of delays and a market turning a little more south or delays in construction, it could rain a lot. Those are some big payments you're having to make on your financing.
Absolutely.
When you're in the affordable market, yes, you don't want to have to pay extra payments, but you're not paying, $750,000 worth of payments.
Right.
Makes a big difference.
Right.
You have to have deep pockets in order to overcome some of those additional obstacles that you have. So you just need to be cautious.
Yeah, and everybody shouldn't be running scared. You really just need to be cautious. With Eddie Speed was on last week, and one of the things that he said that I thought was really, really interesting is how there's a lot of equity in houses compared to what happened back in 2008. In fact, I think he even said that the average down payment for mortgages right now is 16%, which is huge. That means people are coming in to
and new
into a
purchases.
house with,
Yep.
with equity. And, of course, people who have been in their houses at this point have a pretty good amount of equity in the house. So I think that's going to be really interesting to see how that affects our market.
And I think most people learned from, the '08 issues.
We did.
They're not going to leverage their house to the hilt just because they can.
Yeah.
Because if something happens, and the biggest issue that you had with the drop in home prices back then was not the fact that your home was worth less.
Right.
If it's the house you're staying in, who cares? There's no guarantee that
That's
the house
right.
is going to be worth more or less. That's the place you're living. You can afford the payments. That's fine. The problem comes in is if you have to have a job change and you have to move, you can't sell your house.
Right. Right.
So that's the biggest issue, and that's why when we always talk about buy and hold products, that the house doesn't care how much it's worth; it's producing an income. The opposite is true with your home. That's a place where you're living, but the same holds true. As long as you can afford your mortgage payments, it doesn't matter if the thing drops in value. Now, your hope is that it goes up in value. Most people have the most of their net worth tied up in their real estate, but most people now are keeping a nice margin between what they owe and what it's worth. So that doesn't happen again.
Well, hopefully that won't happen again. But it's just a better place for us to be operating from, for all of us to be operating from.
Yeah, absolutely. Your exit strategies are more numerous
and a bit more profitable.
That's right.
It hurts when you have to walk away, from a closing and you had to take money to it to get your house sold, right?
Yeah, that's never good.
It's not fun.
Yeah, I'll pay you to take this away.
That's right.
All right. So question number one, the ugly question. Again, if you have any questions, just put it over there into the chat box to your right or left or down or above. I don't know. I don't know what your platform is. I only know what ours is. Ours is to the right. Well, it's opposite on the camera.
I can't see how many people are on here either. That number's missing.
That's okay. I'm sure it's thousands.
4,000 of people, right?
Yes.
Thank each and every one of you.
We have tens of audiences. So the first question, if I complete my project under budget, what happens to the remaining escrow balance?
That is a great question. That's a great question because
we have a big lunch.
First of all, it is extremely rare that someone ever finishes a project under budget. I mean, as long as we've been doing loans, like since 2003, I can probably count on one hand how many times I've seen that happen. That's pretty uncommon, but it can happen.
And you know what? I guarantee you the vast majority of that one hand, they finished the project early.
Yeah, that makes all the difference in the world is the speed. And I will tell you that the smart borrowers tend to, they know what they can borrow. They know that they can borrow, 65% of what that after repaired value is, right? Mm-hmm. So if they've got room, the smart borrower will fluff that budget. And I hate to say this on camera, but they really need to think about it. If you're estimating numbers or you're given an estimate, you have to assume that things are going to increase in value, like the wood. We just talked about
contingencies too.
Absolutely. And there is a miscellaneous item, line item on our budgets that we put into place. There is a miscellaneous line item, but if you're given, a price range of $6,000 to $7,000 to have the floors done, you need to put $7,000 in there, not the $6,000. You need to make sure that you are covering worst case scenario options.
At the same time, you're fudging, so to speak, or you're
You're just
puffing up.
you're hedging against
No,
issues.
I get that. What my point is, we also have a BS test.
Oh yeah, you can't make a
So
yeah.
we're going to look at it, and it's going to have to be reasonable.
Yeah, absolutely.
But don't undercut yourself, because
Yeah.
once the budget is set, the budget is set.
Yeah,
And there's nothing wrong with having a larger budget than you need.
that's right.
Other than the fact that you're going to pay a little bit extra of a payment. But, over the long haul, you're better off having
More
little
than you
extra,
need than
right.
not enough, because that hurts you in a multitude of ways of
Right.
not having enough. There are some cases where someone will get a price for $4,500 to do the floors, and the actual invoice, and it's in the budget at $4,500, but they were able to save money and they did it for $3,800.
Right.
Well, we're not going to release $3,800. We're going to release the $4,500 that you put in for the floors to be done. So we don't care that you got a
Even
better
if
deal.
your
We're happy
cousin
that you
Tony
did.
it at a discount.
That's right. So we're still going to release that money to you, because that's what was in the budget to make it happen. So if for some reason you do come to the end of the road and you've got money left over in your budget, in that remaining escrow balance, we can put it toward your payoff, but your interest is still going to remain the same. Or we can release that money to you, which seems to be like the smartest decision for you, to be able to take that money and use it for whatever you need to use it for. And it may be a payment, but that would be only after the project is complete, right?
Yes.
So there's ways of working around that. The rehab budget that you come up with and that you put into place is paramount on your success. I'm using big words. On your success of this project. You want to make sure in every case that you have enough money to complete what needs to be done. I promise you, you are going to run into, I don't care how experienced you are going to run into something you didn't expect. Always. Termites in a wall, water damage that you didn't expect. There may be support issues under the house that somebody didn't catch. And that happens all the time.
Yeah. And we like to joke a lot that home inspectors are there to talk the buyer out of buying the house.
That's right. We just had one happen to us
And
yesterday.
To me, it would be a good idea, because, they're not that expensive. Before you put your budget together, have a home inspector go through the house,
spend the $300
and make a list, because it's their job to catch all these little things.
That's right. That's right.
And let's face it, your buyer's going to have a home inspector, and you might as well address the issues that the inspector that they hire is going to bring up.
That's exactly right. That's exactly
so
right.
Use those inspectors to help you catch stuff that you might miss.
Right.
And even then, the home inspector does not have x-ray vision.
That's true.
If you're removing walls, stuff happens.
Right.
There's stuff back there.
Right.
That's why you have a contingency
to cover
in your
that.
budget.
One of the most common thing that I see that I think is missed is plumbing from the house to the street. That is normally the biggest issue that I see when I see anybody doing a rehab, especially so you always have to take the age of the house, how long has it been there, into consideration. And if there are trees that are in between the house and the street.
Yeah, I was gonna say, it's a mature neighborhood. There's lots of trees. There's also lots of roots.
And you need to be aware of that. And that's $3,000 to $7,000. It really depends on how far it is from the house to the street, but that's really expensive and can put a real big kink in the old rehab budget. So that's something you want to be really, really careful about.
Excellent. So to summarize, you get the money back.
Okay, I
Right.
love this. Great advice to have an inspection prior to putting your house on the market, said the home inspector. Thank you, home inspector. Actually, we believe that you should get an inspection before you buy it.
Yeah, part
As
of
an
your
investor.
due diligence process.
Yeah,
Or even if after you've bought it,
yeah.
you still want to make sure
Do it anyway.
that you get an inspector to go in there and make sure that you're fixing the stuff that needs to be fixed as part of your rehab.
Yeah, the important thing. It doesn't mean that every little thing needs to be fixed, because a home inspector is going to point out things that could go wrong, issues that need to be looked at. Their job is to make sure they've covered every single thing that they can possibly find on there. So, I was just looking at one earlier this morning on a house that we're selling, and there are so many things on this report, but about half of them, it's not a new house. So you need to expect certain things that are on the report to be true. I mean, it's not an unknown, but it's on there. And you just need to be really, really aware of what it is you're selling. The better you are, the better reputation you're going to get.
Yep.
The happier your buyers are going to be, and it's better for everybody involved.
Because, if you're smart, you're a smart investor,
Or you're not.
you utilize that inspection report for continuing negotiations if you haven't already purchased it.
That's right.
And if your buyer is smart, they're going to do the same thing.
That's right.
Because it is a seller's market out there.
Yeah.
But at the same time, if there's stuff that, you're not going to get anything unless you ask for it. If you have an inspection report that has a lot of stuff on it.
That's right.
It's a good negotiating tool.
Yeah, absolutely.
All right. So question number 2. What is the difference between a real estate fund like yours and a mutual fund? Well, typically mutual funds are invested in many different companies. So a mutual fund is a stock fund, and it has lots of different buckets that it's in. Why do they do that? Well, mutual funds are trying to be diversified. So they'll have a basket of either other funds or a basket of companies. Of course, you can have mutual funds that are all in one sector.
Right.
You can have them where it's spread
Like
out.
all energy and.
Yeah. Or all dividend paying blue chip stocks. But the point of being diversified is that what you want is to have part of your portfolio goes up when the market goes down and vice versa.
So it's more risk adverse, right? So the first time I ever invested in a mutual fund, this is a story that wasn't funny at the time, but it is now. It was on a Friday in October of 1987 or 88. That was the first time they ever called it a Black Monday. So I invested, I think, a whopping $3,500, which was a lot of money to me back then.
Yeah.
Well, it is today, but it was a lot of, my big savings account, my first jump into a mutual fund. I bought it on Friday, and then Monday was Black Monday, and I pretty much lost every bit of it. It took like 5 years for it to come back.
That's a great. How do you?
Yeah. I don't
October of 1987.
like
Thank you, Scott.
Thank you. It was 87.
You must have a quick Google finger.
He does. That was great. That was depressing.
So when you're in a private real estate fund, and that's what they all are, they're private placement funds. You can have, now ours specifically is in the lending business, but you have plenty that are individual properties. You have plenty that will invest in other funds that invest in individual properties, or funds that are more diversified than individual properties.
Or they invest in apartment complexes and
Properties.
different. Yeah. Well, I immediately think single family when you say properties.
When I'm saying properties, it could be anything. It can run the gamut. It could be, commercial office buildings. It could be mixed use. It could be self-storage. Typically, when they're investing in one property, the price is so high. That's why they have to do a fund just for one property.
Like an apartment complex? Yeah. Okay.
Or very large self-storage facility.
Right. So it's a single use.
Yeah.
Which means it's not really a mutual fund kind of.
It's a single use, but you have diversity in that an apartment complex would have many doors.
Right.
So you have diversity there because you're not depending on one tenant.
Right. Right.
Same thing with self-storage. You would have many units in there. The difference in having a fund for the one property is that the properties are so large they need a fund. Sometimes they need a fund just for the down payment.
Right. Right.
And you're still using conventional
but
financing.
It's a single project, right?
Correct.
Single project funding.
But that said, real estate funds, you can be quite diverse, like a mutual fund. In our particular case, we have at any one time we probably have between 125 and 160 loans in the fund at a time. So that's a lot of diversity. You have a lot of players in there, and one or two stop paying, it's not hurting you.
Right.
If you're in, the one property that's bad and you're an individual lender, doesn't mean you're going to lose any money, right? Just means you're not making any money.
Yeah.
Until you start getting paid again.
Yeah.
Or you figure out the disposition of the property. You can be very diversified and still stay in the real estate sector, because you can be diversified geographically, because you can invest with buy and hold single family real estate that might be in the Midwest and in the South. You could then invest in a fund that has a couple of self-storage facilities, maybe in the Northeast or in the West. There's all kind of ways that you can be very diversified and still be in the same real estate space.
Okay.
If you like the real estate spaces.
I want to talk about liquidity of those funds in just a second. I'd like to answer Banks' question. Hey, Banks, it's good to see you. Do you fund new construction homes made of SIP panels? Yeah, we actually have previously. The bottom line is,
okay, first of all, you're going to have to explain to me what an SIP panel is.
They're preformed panels.
Of what are they made of?
I couldn't tell you.
Okay.
They're made of SIP. We actually have done it before. They're preformed.
Specially insured particles.
So Banks, if you could fill us in on the exact term of SIP, that would be styrofoam. That's it.
Thank
See, I said preformed. I was right. So Scott looked that up real quick too. Thanks, Scott. But they are, and they
structural insulated panels.
Yeah,
I like those.
Yeah. So they go ahead.
Well, I mean, they're allowed in the building code, so
Yeah.
that's not a big deal.
Yeah.
Yeah. Here's what you want to avoid. If it looks like something that no one else has, kind of a specialty. For example, we don't want to do a log home in the middle of a normal subdivision in the suburbs.
Right. Or container homes, storage container
If
homes.
it looks different than everybody else's, that's not something you want to do, because it's going to be harder for that end buyer to get financing for. So we used to joke about the round houses. It was really difficult to get financing on a round house.
You can't find comps for them.
And we had one house that was two round houses with a breezeway, and of course we called it the bra house. Very difficult to get financing on it because it's not typical for the neighborhood.
Yeah.
So if it's something that looks like a regular construction, that shouldn't be a problem.
Yeah, it's just the way that the concrete walls are poured. It's just a different way of doing that. So yeah, the thing is we're going to make sure that you have a contractor that's worked with them before, that understands what it is that you're doing. And we would also highly recommend that you've already talked to the city inspector or the county inspector who you'll be working with to make sure that they understand what it is you're building, because you'll run into these inspectors that say, that's not the way we do it around here.
And that's true. When I had my house built in 98, we had stucco.
Oh, yeah.
And that was right after all the commercial stucco buildings were, growing mushrooms.
Mm-hmm, mm-hmm.
And of course, the county inspector came out and said, well, I don't know how to inspect this.
Yeah.
I said, well, you better find somebody that does. This is a regular stucco house. It's
Yeah.
not the preform with the foam backing behind it.
That
Like
caused
commercial.
a lot of problems in our area.
So, yeah, it was an issue then.
For sure.
So yeah, just make sure that they understand what you're working with.
Awesome. Thanks for that question. Now let's talk about the liquidity.
Yeah, no
of
one has
mutual
any
funds.
money.
The liquidity of mutual funds versus a fund like ours.
Well, your bigger mutual funds, it's not a big deal. The longest you have to wait for is them to sell your stock.
Right.
And I guarantee you, when you put your sell order in, you want to move that money. You want to sell it, get out of it. You want to get liquid. You want your money back out of the mutual fund. You put in your request. They have to sell all the stocks. Now, here's the thing. Because it is diversified into many different baskets, the length of time to sell all those stocks are going to be a little bit longer.
Mm-hmm.
But
you're really only talking a couple of weeks,
yeah,
right?
Yeah. But I can almost guarantee you, they're never going to sell at the price they were when you put in the order.
Yeah. How quickly do you want your money back?
For some reason, it always tends to be a little bit lower than you thought. That said, here's what I hate about the publicly traded stocks and funds versus the private placement. They're harder on the private placement people.
Mm-hmm, mm-hmm.
Any fees that we have is in our paperwork, and they're disclosed up front. And you're going to be really shocked at the number of fees that will come out of your mutual fund.
When you
had no idea
Mm-hmm.
they were even a part of that.
Yeah.
And what really irritates me the most is that if you have a front-loaded fund.
What does that mean, front-loaded?
Well, they have what's called a no load, and then they have a loaded fund. Well, basically, that's your broker's commission.
Okay.
Okay. So a loaded fund, I'll give you an example. Let's say the load is going to cost you, and we'll use this in loan terms, 3 points. Okay. So $3,000.
Mm-hmm.
And you have $100,000 investment. Well, when you give them that $100,000, your first statement shows your $100,000 and the money that you're making off of it, and it stays at $100,000, and it shows how your investment is growing. Well, guess what? Your real investment's only $97,000 because they took the $3,000 out, but they're allowed to tell you you invested $100,000.
Yeah, yeah.
They tried to in Congress require those people to do the proper disclosure, and it was shot down by all of them, both Republican and Democrat.
Huh.
So I can't believe they're not allowed to, or they're allowed to do that.
Oh, they're not forced to tell the truth, but their lobbyists must
So
be really good.
Let's get back to the liquidity thing. In all real estate funds specifically, there is going to be a lack of liquidity. Now, we do know Dave Van Horn has a fund, PPR,
Mm-hmm.
and he has a fund where you can get your money back in 90 days.
That's right.
Now, obviously, the easier it is for you to get your money back, the less you're going to earn in your annual return.
Right,
So
right.
just be aware of that. The easier it is to get your money back quickly, the less interest you're going to make, or the less dividends. Or
Normally.
distributions that
Yeah.
you're going to get. But for the most part, real estate funds are going to be low in liquidity. What I mean is if you're doing something, let's say an individual property like an apartment complex or self-storage, and it's a closed-end fund, the thing is over with in 5 to 7 years.
Right.
You're not getting your money back for 5 or 7 years or whatever the transaction that triggers the end of that fund.
Yeah, they have no way to give you the money back because they're using the money in the project, right?
Same thing with lending funds. Now, the difference with ours is that it's shorter term loans. They're expected to be 6 months. So the likelihood, so that money's turning over a little bit sooner than that. But you can't go to a borrower and say, I'm sorry, our investor wants their money back. You're going to have to pay your loan off early. That doesn't work. But if you're ever going to invest in a fund of any type, stock market as well, it needs to be a 3, 5, 7 year plan. You don't want to invest for the short term in that because number one, it's too much trouble, and it's not designed for short term investments.
Right.
If you have to have that money back right away, do a hard money construction deal yourself.
Yeah.
Be aware though, there's a lot more risk when you're doing it yourself, and there's a lot more work, a lot more due diligence. Even then, there's no guarantee you can get your money back at a particular date because you can't make them pay that off early.
Right.
If it's a 6-month loan, you're at least going to have it for 6 months.
Right.
And it may be longer because they may not be able to sell it right away.
Yeah. Talk about the waterfall language that in a fund.
Well, it depends on the fund.
That's right. So talk about that. Talk about what that means.
Well, you have several things that will trigger a waterfall. One of them is the fund shutting down and how everybody gets paid. Or let's say the fund is leveraged. All right. So let's say you have a fund that has leverage on it. And what does that mean? That means the fund, for example, let's say you have $10 million in your fund. You can have these credit facilities that will come in and say, well, I'll lend you $5 million
on your $10 million.
On your $10 million worth of assets.
Notes that you already have in place.
So why would a fund do that? Well, because now I can work with $15 million.
That's right. Instead of the 10.
And that money, that $5 million they're giving me, is costing me 3.5%. But as an investor, you're getting anywhere from 7 to 9%.
So you're making a little.
So the fund is making more money. Now, by the way, that comes to the investors. It's not the management company that's making this money. The fund actually gets a higher yield because they've got extra money that they can use. That's costing the fund less. Everything's hunky-dory as long as the economy is moving along nice and smooth. But here's what happens in a waterfall event when you have your assets that are levered, or there is basically a lien on your first lien position. And guess who has in first position or in the A piece? That would be the credit facility that made the loan. So here's a worst case scenario. You have another 2008 that happens. Everyone that's in the fund gives their property back. You have to foreclose on every property. Well, what do you do as a fund if you have to foreclose on every property? Well, you become property managers.
That's right.
You take those properties, and first and foremost, you want to sell them. But if the economy is crap at the time and you can't sell them, well, you don't want to sell them at a loss because then everybody will start losing money that's in the fund.
That's right.
So your plan is to rent them out, make some money until the economy turns around, which it always does. We all know that. And then the values come back up, and then you can sell them. Well, in the meantime, if you're an investor, and let's assume your expected return is 7 to 9%, And because you've had to rent all these properties out, now your return is 4 or 5.
Right.
All right. Well, it's a tough pill to swallow,
It's
but
not
hey,
gonna
you're
kill
making
ya.
money.
Yeah.
Right?
Yeah.
Well, if you're levered
Yeah.
and that credit facility wants their money back because these contracts run for a year at a time.
Right.
And if you're in a down market, they're going to want their money back.
Mm-hmm.
They get all that 4 to 5%.
Yeah, they're going to get that 4 to 5%
because
that's all that's there.
They're in the big, they're in the senior position
Right.
on those assets.
Right.
So they get all the money, and what happens to the investor?
Squat.
They get nothing.
Mm-hmm.
They have to sit there and make nothing. Now they still own part of the assets,
right?
Until this credit facility is paid off.
Right. Now, if they decided to sell the products that are inside the fund,
who?
The fund.
Who sells?
The management company, the fund. If the fund decides to sell it, the proceeds are going to go to the bank first.
Well, they got to get that leverage paid
right.
off
They
first.
got to get that paid off first. So now you're losing even more money on.
Well, that's if you sell it at a loss.
Right.
Yes. But a good fund manager is going to halt any redemptions and hold on to those assets until the market turns around and sell them at a profit.
Yeah. I love that last question that's up there. Okay. That's a great question too. Why are so many investors interested in flips? There are plenty of entrepreneurs trying to get funded, but it seems the money out there is being sucked up by flips. I'm trying to figure out what entrepreneur means to you. I don't know what kind of business you're talking about. If you could give me a little more information on that. Investors are it's interesting that you talk about flips. When we're talking about flips, we look at two different things. You've got your buy and sell, buy, fix, and sell. And then you've got your buy, fix, and hold property. So a lot of people are looking more into the hold side. But when you're doing a fix and flip, you are getting money in the bank right then. It's your current eat money. That's really what you're looking to do. And you go from hero to zero on the day of closing. Right. So you've got to start that all over again, where when you buy and hold, you're having the opportunity to build an income off of what it is.
Build wealth over time.
Right.
Tom, if you would, give me a little bit more detail on what other type of entrepreneurial projects you're talking about, and we'll address that.
Yeah. And most hard money companies don't lend to businesses.
Well, we do lend to businesses, but not
as a business.
But we have to have, real estate as
yeah.
What am I trying to say?
As the collateral. Okay, starting a restaurant. Starting a restaurant, starting a manufacturing business, buying it. So you're really talking about a business in itself and not real estate.
So yeah, hard money lenders are only going to do real estate backed loans. They're mortgage companies.
Yeah,
so
that's what we are.
Businesses. However, what you're thinking of are more like angel investors that will, take a chance on a business model. I can tell you that restaurants are very risky
right now.
You can see, even before COVID, restaurants are very risky.
Yeah, they're average.
A lot of them don't stay in business very long, and now some do, and it's tough to be a restaurant owner too, because you're always working on holidays and nights and weekends.
Yeah, tough job.
And it gets tough. It's also a big cash business too. You have to have cash to buy your food and all your other items.
And trendy. They're all
biodiesel plant. Again, you're talking about energy, and you have to have a lot of deep pockets for the energy business. So those are kind of the ones you're discussing right now are more risky. So you're going to have to deal with angel investors, and those people, they don't mind the risk if it's got a good scalable model. Okay. Most angel investors typically invest in 30 to 40 businesses, hoping that one or two of them will work. Okay.
Just like Mr. Wonderful and Shark Tank.
but their biggest thing is they're going to want to see that it's going to be scalable, because if they're they're not going to invest in somebody's diner. They're going to invest in something that can be franchised
Right.
and, opened up and expanded nationally.
Yeah.
Right.
Yeah. And that, so crowdfunding is probably one good way to get people to hop in on something like that. The other thing is your SBA, the Small Business Association
they lend on
loans.
businesses.
Yeah, and they're actually pretty liberal with what they're lending on.
That's why they're a good choice for self-storage, because self-storage is real estate and a business.
Yeah, so when you and
SBA
that's well said. Well said. If you've got a piece of real estate that goes along with the business that you're doing, daycare centers, self-storage, even restaurants, the things that you're mentioning. If you got a piece of land or some sort of a building that goes along with it, the SBA loves that. Because they've got kind of double collateral in their minds on that.
Let me go back and touch on Waterfall real quick, because I don't think I really finished this out.
We've only got a few minutes too.
The Waterfall, and it's going to be in every single set of documents depending on the fund, will spell out who gets paid first.
Mm-hmm.
Typically, it's note holders first, then it's investors. Okay, so that's kind of how the Waterfall works out. So if a fund is closing down, it's the people that own notes first. So if you have a fund that has a debt part of the fund as well as an equity part of the fund, the debt holders, the note holders, are going to get paid before the equity people. But at the same time, the debt people are getting a lower return typically than the equity people. The equity people are the ones that are taking the biggest chance. So let's call the fix and flippers the equity people.
That's a good example,
because they are taking the biggest chance, but they also have the opportunity to make the most money.
That's right.
All right. So we're closing in on it.
Yeah.
Do we have any other questions?
Yeah. And here's the other thing I want to mention. We love, thank you, Tom. We love getting these questions from you guys, and we do. It's what's really funny is when we end this video, usually every Thursday, I get inundated with questions from people that were on here that didn't ask things. And it helps us when you ask us questions like that, because we're not here to beat our chests about how great and wonderful we are. We really want to educate you, except for Billy, he is. But we really want to educate you and answer the questions that you have about, any type of borrowing, any type of real estate investing, any type of fund that's going on out there, any issues that you might be running into. We want to be able to help you with that. And if we don't know the answers, we can connect you with somebody who does.
That's our ant cam.
Yeah, I don't like that one.
Cam.
I don't like that one.
Right, too low to the ground.
Yeah, it just makes me look like a huge tent. I said that to somebody one day, and they said, "Oh, I just hate that picture of me." And they go, "Well, the camera takes what it sees." They are not my friend. Right. Okay.
On that note,
so you can send an email for any question that you may want us to address on film, on video, so everybody can see it. Send it to Wendy at carolinahardmoney.com. And we'll get those questions answered for you at any time, right?
Yep.
Don't forget to join our next segment. It will be awesome. Jeff Johnson, there's my email address. Jeff Johnson and Don Harris are going to join us. Jeff Johnson's a big wholesaler. He's also a builder. Don Johnson, he was with Miami Vice, but Don Harris. Don Harris
he's still pretty cool.
Yeah, he's my superhero in the real estate business here in the Charlotte market, and you're gonna learn a lot from both of them.
Excellent. So if you want any information about us, it's carolinahardmoney.com. If you're a borrower, click on the borrower tab. If you're an investor, click on the investing tab or the investor tab. Now, investor means you want to invest in our fund. I know sometimes the language gets a little crossed there.
Yeah.
Please don't forget to subscribe, share, and like. If you subscribe, then you will get notification every time we come on here with our smiley faces. So a couple of weeks from now, we're going to be in Tampa at our Collective Genius event, and I think we got a great show coming
We're going
up.
to come live to you from
We're
there.
going to take our 2 hours that we normally do, and we're going to broadcast live poolside, and we're going to have probably 20 or 30 of some of the best investors in the country come in and give tips during the 2 hours.
Yeah, it'll blow your mind. It'll blow your mind. So mark your calendar
and you'll
for
be
that.
jealous because we'll be by the pool.
Yeah, and it's not next Thursday. It's the Thursday after that.
Yeah, I think it's the 14th.
Yeah,
is that
yeah.
the date? Anyway, all right.
No,
You guys have a
16th,
great day.
Like
Like I said, don't forget to share, like, subscribe, and all that good stuff. We'll see you in a little while.
Thanks.